Nokia stock on the New York Stock Exchange under the ticker symbol NOK is currently trading live at $15.93 during the Friday, June 5, 2026 intraday session, marking a noticeable decline of 4.78% so far today. This sharp pullback follows an intensely volatile week where the stock initially skyrocketed to a fresh 52-week high of $17.44 before experiencing severe profit-taking and technical resistance. While the daily chart shows a rapid cooling-off period, the underlying trading volumes tell a story of institutional repositioning rather than retail panic. Volume on the New York Stock Exchange has surged past 2.5 million shares early in the session, reflecting an aggressive tussle between short-term traders locking in substantial gains and long-term accumulators defending key structural support lines. To see an old-school telecommunications giant swing with this level of velocity shows that something fundamental has shifted under the hood, changing how large-scale asset managers evaluate the equity. The unexpected insight that most investors are completely missing right now is that this massive volatility isn't actually being driven by traditional telecom infrastructure contracts or standard 5G hardware deployments. Instead, the real catalyst is Nokia's sudden emergence as a core component provider for high-capacity hardware installations inside data facilities. Major capital allocators who used to look at this business as a slow-moving utility play are suddenly discovering that Nokia has quietly captured a significant share of the optical transport market, which involves deploying sophisticated fiber optic systems to transmit massive data sets between server clusters with minimal lag. When you look at popular online investing channels, the focus remains almost entirely on specialized hardware providers or high-profile chip makers. Yet the physical switching architecture and the fiber systems that tie these multi-billion-dollar computing clusters together represent the true operational bottleneck. Nokia's recent financial metrics reveal that sales specifically tied to these high-capacity data facility operators surged by an astonishing 49% in the first quarter of the year. This specific operational pivot explains why the equity has experienced a massive 159.6% surge over the last 6 months, totally decoupling from its historical trading range. Establishing common ground with the current market narrative, the general belief among retail investors using platforms like the Robinhood app or browsing popular investing sites is that Nokia is a relic of the past, permanently stuck in the shadow of modern technology giants. The prevailing sentiment assumes that the company's growth is forever capped by the slow spending cycles of major mobile carriers who have already finished building out the bulk of their regional 5G networks. This logic leads many self-investing individuals to believe that the recent stock surge is nothing more than a temporary speculative bubble fueled by retail hype. However, if you look beneath the surface, the reality challenges this view. The deeper analysis reveals that institutional giants are aggressively buying into Nokia as a strategic proxy. NVIDIA's massive $1 billion investment for a 2.9% equity stake in Nokia established a structural floor for the valuation, signaling to the wider market that Nokia's hardware architecture is absolutely essential for the next generation of interconnected computing infrastructure. When a dominant chip producer allocates that much capital into a European telecom provider, it changes the entire narrative from a simple hardware play to an essential infrastructure partnership. Examining the recent price action through major online investment platforms, including SoFi Invest and Interactive Brokers trading accounts, reveals a distinct divergence between short-term technical indicators and long-term institutional accumulation. Over the past few sessions, the trading volume has spiked significantly above the 50-day moving average, a classic signal that institutional funds are actively rebalancing their portfolios. This intense buying pressure pushed the stock well past the consensus price targets held by traditional Wall Street firms, which had stubbornly pegged the stock's fair value closer to $9.81 based on legacy financial models. When a stock breaks through Wall Street's expectations with this much velocity, it triggers automated buying algorithms across systematic trading desks, further accelerating the upward trajectory. However, today's 4.78% intraday decline highlights the natural friction between aggressive forward-looking expectations and immediate fundamental realities. The stock's trailing price-to-earnings ratio has stretched to a demanding 100.2x, a valuation multiple typically reserved for high-growth software enterprises rather than heavy industrial hardware manufacturers. This multiple expansion indicates that macro asset managers are pricing in flawless execution over the next fiscal year, leaving almost zero margin for operational errors or supply chain disruptions. To get a clearer sense of how the broader investing community is positioning itself right now, comment below how many shares of Nokia stock you currently hold in your portfolio and whether you are buying this dip or waiting for a deeper correction. Watching the retail order flow across individual brokerage setups reveals that many smaller accounts are aggressively using features like Robinhood fractional shares to accumulate positions during these intraday drops, betting that the structural partnership with major computing firms will provide a permanent lift to the baseline valuation. At the same time, more conservative investors utilizing traditional platforms like Schwab Intelligent Portfolios or a standard Fidelity broker brokerage account are exhibiting caution, noting that the forward price-to-earnings ratio of 42.1x still represents a massive premium compared to Nokia's 5-year historical median of 19.7x. This tension between aggressive momentum traders and value-oriented asset managers is what creates the massive daily trading volume we are currently witnessing on the Interactive Brokers platform. Understanding the business model requires looking at how Nokia actually generates its revenue across its newly organized corporate structure. Late last year, executive leadership made the strategic choice to split the business into distinct operating units, creating a clear division between the legacy mobile infrastructure group and the high-growth network infrastructure division. The mobile infrastructure side remains focused on standard cellular antennas, routing hardware, and localized telecom systems, a business that is currently experiencing flat growth due to intense global competition and reduced capital expenditure from traditional wireless carriers. The network infrastructure division, however, is where the real fundamental expansion is occurring. This unit designs and manufactures high-end optical switches, IP routing systems, and advanced broadband access technologies. By embedding intelligent automation agents directly into their software platforms, Nokia allows data facility operators to automate network planning, deployment, and real-time troubleshooting, significantly reducing the massive operational costs that typically plague large-scale fiber networks. This software layer provides a recurring revenue stream that carries significantly higher gross margins than their traditional hardware sales, shifting the long-term profitability profile of the entire company. Looking back at older financial reports helps put the current market excitement into a historical context. For years, Nokia was viewed as a value trap, characterized by low single-digit revenue growth and restructuring charges that repeatedly dragged down net income. However, the first quarter earnings report turned that narrative on its head, revealing a 54% surge in comparable operating profit to 281 million euros, significantly outperforming the consensus analyst estimates of 250 million euros. This massive earnings beat was directly driven by the sudden acceleration in spending from large-scale hyperscale data center operators. This performance contrast shows how the expectation of a stagnant telecom supplier collided with the reality of an infrastructure provider experiencing a surge in high-margin enterprise demand. Even though overall telecom revenues remain soft globally, the rapid adoption of their specialized optical transport gear completely offset the legacy weakness, forcing major research institutions to rapidly revise their internal valuation models. For investors managing their capital through self-investing strategies across platforms like Robinhood Stock Trading or SoFi Active Investing, the future outlook for Nokia stock depends entirely on whether the company can successfully bridge the gap between speculative valuation and sustainable cash flow. Multiple future scenarios are currently playing out. In the most optimistic scenario, the continuous build-out of centralized computing facilities requires a massive, sustained upgrade cycle for optical switching gear, allowing Nokia to maintain its elevated growth rate and justify its current valuation premium. This upward trajectory is further supported by recent regulatory clearances, such as the conditional approval from the Federal Communications Commission, which exempted several of Nokia's core broadband devices from restrictive listing hurdles, ensuring uninterrupted deployment across major domestic service providers. Furthermore, the newly established innovation facilities in California, operating in direct partnership with semiconductor and server manufacturing giants, provide a strong ecosystem that could cement Nokia's position as the preferred architecture for high-speed data transmission. Conversely, a more conservative scenario must take into account the substantial risks associated with an industrial hardware business trading at a historically high valuation multiple. If macroeconomic pressures force major technology firms to scale back their capital expenditure budgets, or if competition from traditional rivals intensifies, Nokia's revenue growth could quickly normalize, leading to a severe contraction in its price-to-earnings multiple. The lack of recent open market insider buying from top-level corporate executives over the past quarter also introduces a layer of skepticism, suggesting that the individuals running the company view the current stock price as highly reflective of future potential, leaving little near-term margin of safety. For individuals structuring long-term wealth portfolios using diversified tools like Fidelity ETFs, Fidelity mutual funds, or automated robo-advisors, these valuation extremes require a careful balance between growth exposure and risk management. To wrap up our analysis, the central insight governing Nokia stock right now is the intense structural tension between expectation and reality. The market's legacy expectation was that Nokia was a mature, slow-growing telecom business tied to the cyclical nature of mobile carrier spending. The reality is that through strategic reorganization, key institutional backing, and a massive surge in demand for high-speed optical transport architecture, the company has transformed its operational profile into an essential provider for data facility connectivity. While today's intraday decline to $15.93 reflects short-term profit-taking after an extraordinary multi-month rally, the underlying institutional volume and high-margin product mix suggest that the business is operating on a completely different fundamental plane than it was just a year ago. Investors navigating this story through modern online investing tools must weigh this fundamental transformation against a stretched valuation multiple that demands flawless execution in the quarters ahead. Disclaimer: this video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video, comment your thoughts, share with your friends, subscribe for more updates.